Hello everyone, welcome to another ITPM Flash. My name's Anthony Iser, and today I'm going to discuss the topic of same but different. Now, if you've been to Thailand, you will have heard that phrase. It essentially means things are similar. Markets today are very similar to how they have been in the past. Now, markets don't repeat, but they certainly do rhyme, and that is very true of what's going on in the market today. So firstly, I want to talk a little bit about how things are a bit different. I'll talk about how things are similar, what the risks are from here, and how we might be best to play it. So first thing is, if you look at this chart here, you'll see that this bond market sell-off is something we've never seen before. Since the US was founded, Republic formed, we've never had three down years in the bond market in history. So certainly very different negative outcomes for bondholders. How bad is it? Well, if you look at this chart, you'll see that the drawdown on ultra long duration bonds is now worse than the equity drawdowns that we saw during the GFC. So that's pretty much as bad as you can get. Now, another point in where this is different, historically at Fed pauses, we tend to see yields start to come down. This time though, as this chart shows, we're seeing this big spike in yields. It's very much an outlier. And it can be a whole range of things that are causing this, one of which maybe the Fed isn't at a pause stage yet, and that needs to be considered, that the Fed is going to raise rates further from here, which would be a policy issue, which would lead to a hard landing. But as I'll talk about soon, I think that's probably inevitable anyway. So what is going on with this bond market, and why is everyone talking about it at the moment? Well, the first thing is, if you're on a trading desk anywhere in the world, at some stage you would have heard someone say more buyers than sellers, or more sellers than buyers, in response to a question of why is X stock going up or down. What we've got in the bond market at the moment is very much that scenario. We have more sellers in terms of volume, which is the US government, huge amount of fiscal spending, deficits they need to fund, issuance of government bonds. In terms of buyers, the buyers are a little bit more on the sidelines than they have been in the past. The US Federal Reserve, of course, is quantitative tightening, so it's easing up. China, Saudis, Japan, all buying less than they have in the past. So we've got this situation where yields have to go up, bond market has to go down in order for supply to meet demand. There is that risk that the buyers pull back even further and we see another spike in yields from here. Now, the second part of this is that fiscal spending. The government is spending too much money. The government in the US is also an absolute mess at the moment. You've got Matt Gaetz and his merry band of morons who have just ousted Kevin McCarthy. Markets don't like uncertainty. There's no speaker for the House. It's going to drag on. This is confusing for everyone. It puts doubts on government funding in place. It's not what we want to see. So until there's clarity on that, there's going to be elevated volatility as well in the bond market. But this is the market saying to the government, you need to start reining in that spending. The other point, as I mentioned earlier, higher for longer, the Fed is ruling the roost here. Okay, so what we need to understand that this narrative of higher for longer may mean rates a little higher than longer and flat in the short term. It may mean another rate rise, but it may mean that the long-term neutral rate is going to be higher as well. And that's negative for equity markets. Now, why is all of this pretty negative for equity markets? The first thing is the Fed rules the roost. Think of Jay Powell as you would Tony Soprano. He's the boss and what he says goes. So until he eases monetary conditions, we're going to find that a hard landing is on the horizon somewhere. Whether it's 3 months, 6 months, 12 months, but it's on the horizon. Tight financial conditions and tight lending conditions has historically always led to a recession and a hard landing. This is not a plane that the Fed has ever been able to land. They crash land into the tarmac pretty hard. So as you can see on these charts, the lending conditions remain very tight. There's no reason why there's going to be a soft landing this time around. And if you saw Ed's presentation last week, he would have talked about the first domino to fall. 3 dominoes, lined up, ready to go. The consumer is now starting to be under a little bit of pressure. We saw that again today. Oil prices down dramatically. Why were they down? Because consumer demand is falling off. The consumer is facing increased pricing pressure at the petrol pump. Demand's dropped, and inventory is going up. Signs of slowing consumer demand, reiterating Ed's view on this domino falling. Now, soft landing has been the narrative for most of the year, and this is still very much a same but different situation. Firstly, we've got the NASDAQ up year to date. Record levels, never been seen at these levels before. So understandable, people are getting pretty excited. GDP, pretty strong. Unemployment, barely a tick. So all those things that Ed spoke about last week in place. That's why people think soft landing, here we go. Now, there's many things that precede a hard landing. One of the key things that precedes a hard landing is the media and retail focus on the likely outcome of a soft landing. So here's a range of things just to highlight that for you. Firstly, Wall Street Journal articles spike prior to recessions. Journal articles about soft landings. So do Google searches. So retail traders getting in there, looking at soft landing. What does it mean? All that sort of stuff. It's same, but different. It happens every time. So you can see here is a montage of soft landing headlines from every recession in the past, preceding every recession. This time is not going to be any different. And today, perhaps we saw the first couple of changes in this narrative coming through with the talk of the missing of the soft landing and potential hard landing to come. So what do we do here? Firstly, we're going to have very volatile times. There's going to be up days, down days. Trying to do something on a short-term basis is going to be really hard. So what I would be looking at would be a continuation of what we preach at the Institute, is a diversified portfolio of uncorrelated trades. Secondly, the downside's got a long way to go in a hard landing scenario. Consumer discretionary is down a little bit, but as you can see from this chart, it's still up year to date and would have a long way to fall. The third point would be looking at a barbell strategy and some ideas. That is getting insurance in both directions. Now, with insurance in general, you do not want to be collecting it. It's like house insurance. You don't want to collect it. It means your house is burnt down. You don't want to collect on these outlier trades, which might be long, very high beta tech, out of the money that might pay off in the options market, or out of the money short consumer discretionary or short loss-making tech. It means we've had a massive move in one direction. That's really tricky, but you want to have that insurance there. The final thing to think about would be a mean reversion trade, like this chart here, which would be short the NASDAQ, long TLT. Now, it's important to note that that gap is likely to close, but be careful. It may take a long time to close. And as part of the whole same, it's different theme, it might get worse before it gets better. So there we have it. That's what's going on with the bond market. That's why everyone's focused. You've got to watch out below. Hard landing is on the agenda, whether it's 2 months, 3 months, 6 months. The signs are starting to come through. And our friend Jay Powell, well, he's going to break something. And it's likely to be the equity market to some degree as well. Okay, take care. Good trading. Talk to you soon.